Hello and welcome to the Providence Quarterly Global Outlook and Strategy. My name's Grant Patterson, founder and CEO of Providence, and I'm joined today by Mark Waite, Head of Investment Strategy. Welcome, Mark.
Thanks, Grant.
Mark, I noticed the title of the GOS this quarter is A Good Vintage. Where did that come from and what does that really mean?
Well, it might have come from a conversation between the two of us, Grant, but I think what it really points to is the increase in the cost of capital has repriced many asset classes and has meant that there's quite a lot of dispersion across markets, and there's also some really interesting returns from credit.
Yeah, I think it's going to be quite an interesting period of time ahead for setting portfolios for the next 3 to 5 years. I'm quite excited about the outlook. But let's have a look at the year in review. Really much a tale of two halves, very volatile over the full 12 months. Can you give us a bit of a take on the year just past?
I mean, I think front and centre for 2023 was really heightened concerns about interest rates and inflation. And there was a lot of concerns as we came into the second half of 2023 about, will inflation come down? Will it re-accelerate? Will central banks have to hike rates again? And that was really a big focus for the markets. I mean, it led to sort of a violent sell-off in the bond market in the third quarter, yields touching 5% on US 10-year yields, equity markets selling off, people concerned about the regional banking crisis. And then as we sort of saw some better data, as we saw a sort of a dovish rhetoric from the central bank in the US, we saw quite a sharp reversal and quite a strong rally in equity markets, meaningful falls in bond yields as we went into the fourth quarter of 2023.
Yeah, it was one of the sharpest moves upwards in interest rates that I've seen in the 40 years. So it was very abrupt, and you know that led to a lot of concerns in markets. And I know we were pretty cautious in the first half of the year. But I think as we started to look through that, we pivoted and started to increase our assets to growth. So we didn't see the big drawdowns, but we needed to get longer, growth assets, I think, as more certainty came to the market.
Absolutely. Yeah. And I think the story was really one around sort of the second half was one around more confidence in sort of the earnings profile for some parts of the equity market, less concern in terms of will inflation get down to a manageable level. It might not hit targets of central banks, but it's not going to have a 7 handle, it's going to have a 3 handle potentially. And then I think that's really sort of been the story, and they were the reasons that we really pivoted towards growth assets in terms of equities and in terms of credit.
And just having a look at the various performance of the asset classes over the last 12 months, can you just run through what were the standouts?
Sure. I mean, the standouts were, I think, gold. I mean, getting a 20% plus return for gold, that was really interesting.
Yeah, it's a bit unusual to get that from a defensive asset class.
That yields nothing. Really interesting. And then I think obviously front and centre on everyone's lips is AI and the impact on the Magnificent Seven. So if you look at that index of those stocks, that was up 54% over the past year to the end of June. And then also I think sort of US equities did well, as that was the economy where the earnings were coming through. And you saw those stocks lead. Japan was really interesting. So we saw some really high returns from Japan as the corporate governance phenomenon came through, and indeed sort of alpha there as well.
And the Australian equities really lagged. I mean, we're probably the most underweight we've been in Australian equities.
And that's really sort of been a couple of concerns. It's been concerns on earnings. So as the sort of overhang of the slowdown in the China property market has impacted commodities, as some of the sort of EV metals such as lithium have weighed on the market. I think the other thing in Australia has been a stickiness around inflation. So we've seen much more stickiness in inflation.
So Mark, let's start looking ahead. The economic outlook, I mean, there was concerns about a recession, and then the US economy was quite stronger than people expected, but we're starting to see a slowdown. What's the outlook in regards to the global economic view?
So I mean, I think there's weakness in China, and we need to continue to sort of watch that. In the US, we've gone from fears of recession to reasonably strong levels of growth and strong levels of company earnings. More recently, we're seeing a little bit of a slowdown, but much more sort of a soft landing. It would be what we'd expect. And that's really borne out by sort of the way in which households have fixed their interest rates. The average mortgage rate is around about 3.7% compared to current rates above 7%. A lot of corporates have termed out their debt, so there hasn't been as much hit to the households, particularly when it's combined with the big fiscal transfers that have occurred. In Australia, probably a little bit weaker environment. I mean, we've seen a per capita GDP recession. We've seen big pressures, potentially more interest rate increases in Australia. So a little bit more pressures in Australia, I'd say.
Yeah, and I know that Steve Roberts on our investment committee, our economist, has been very accurate over the last couple of years, and his concern is that inflation, although it's been trending down, is going to remain quite sticky, and that may have an impact for longer term interest rates.
Yeah, and I think his point is a really good one, and it's been very true. It's been around, whilst inflation's come down from those sort of high single digit levels, it's going to be some time before it gets back to target, particularly in countries like Australia, where we recently saw a print above 4%.
Yeah. And of course, the higher interest rates are helping a lot of retirees at the moment, putting a lot of money in their pockets.
Well, that's been the big narrative in markets, and I think it's really important. The impact of sort of how the financial and economic conditions have hit different parts of the economy. So you've seen the wealthier baby boomers, Generation X's, with meaningful financial assets actually do well from higher interest rates and financial asset appreciation, whilst it's sort of hurt some of the younger cohorts where interest rates are high, it's harder to get on the property ladder, et cetera, et cetera.
Yeah, I mean, it's been a case of where the debt has really moved from households and corporates into government. And I suspect in an election year, you're not going to see governments not spend ongoing money.
No, and I think that's really right. And the market at different points in time have had some concerns about sort of the fiscal and the largesse that's happening in terms of government spending and the increasing of debt.
Yeah.
And that'll be something to watch going forward.
So just looking forward in that sort of environment, what sort of outlook do you have for asset classes, and where are we positioning portfolios?
Well, I think as we started, we think it's a good vintage.
Yep.
And we think the fact that you've got sort of looking forward after such a big drawdown in 2022, we'd expect that the equity markets can continue to perform.
Yep.
But what we would think is that you'd see more broadening out in performance. So in the US market, you'll see earnings come through to a broader part of the market. In areas like Japan, we think there's some really good opportunities there for sort of corporate governance and reform. So we see those as good opportunities. Credit, really interesting asset class, structurally higher interest rates. The value's been transferred from private equity owners towards the credit market. So we've had managers there that have had pretty spectacular returns in recent times and done it managing the credit risk quite well.
Yeah, so I think our positioning is still pro-growth from where we're at. We're starting to be very opportunistic in some distressed areas, in distressed credit. I mean, the refinancing risk of commercial mortgage-backed securities has still got a long way to go. We've seen some repricing in property, which looks quite attractive to us. We're getting equity-like returns out of less risk in credit, which is attractive, and gold is still there in the portfolio, which is probably a good segue into the risks that we see in the markets.
So I think the way we defined our sort of outlook was passing the baton from heightened fears and heightened volatility around concerns on inflation and interest rates towards geopolitics this year. So that's really sort of top of the tree in terms of concerns. So we'd want to continue to watch that. That's why we have gold in the portfolio. And I think that's an important thing. Diversification is arguably the best way to diversify that. The second thing is sort of the political outlook. And as you noted before, government spending a lot of money. Potentially over time, that might put some more pressure on long-term bond yields as sort of investors want a higher discount rate for those assets. So that's something to watch in terms of concern. And then the third thing is what we touched on before, is whether you might get a re-acceleration in inflation.
So Mark, pulling that all together, what is the positioning of the portfolios at present?
So the broad tilts in the portfolios are overweight global equities, so meaningful allocation to the US market, an allocation to Japan where we see some good opportunities of corporate reform adding value to those companies, overweight mid-cap global equities, and we think that'll start to come through in the year ahead. And then in terms of Australia, we're underweight, so we see continued sort of pressure on earnings, drag in the resources sector a little bit in terms of China until that story turns around. We like credit. We have around about a 10.5% weighting in credit within our balanced portfolios as we see yields around about 10%.
The last time I saw these sort of returns out of credit was back in the 1980s, so it's certainly helping the income in the portfolios.
Well, it's a great time to harvest yield. It's a great time to harvest yield. Gold is the sort of important stabiliser in portfolios around geopolitical risks. And we have a modest allocation to government bonds. So we're pretty significantly underweight compared to our benchmarks. And we think that's a good space to be. And then opportunistic property, which is very much taking advantage of the repricing of assets.
Yeah, and I think going back to the original, good vintage, I mean, I think there's going to be a lot of dispersion within and across asset classes, and you are going to see some levels of stress, I guess, in refinancing or assets that are having to come to market for various reasons of redemption. So, I think the past vintages back in, 15, 16, 17 are going to end up being quite subdued, and public markets will actually perform quite well, and I think there'll be some of those private assets come to investors now at very attractive levels.
Well, it's interesting, isn't it? I mean, we've recently seen an office building, 50% share in an office building in Sydney trade at a capitalisation rate of 6%.
Yeah.
I mean, that was an asset that would have been a 4% asset a couple of years ago. Also, I think we're really excited about our distressed credit manager. They're seeing lots of opportunities in the US in terms of that repositioning of capital and restructuring of good companies with bad balance sheets.
Yeah, so I think there's going to be some great opportunities there and be opportunistic, but in the background, portfolios, balanced portfolios should still be able to, provide a 4.5% type income
Absolutely.
in this current environment.
Absolutely.
Terrific. Well, thanks very much, Mark.
You're welcome, Grant.
Thanks very much for joining us. I'd just like to announce 4 new staff members that have joined the Providence team. James and Michaela in Sydney, Per in Adelaide, and George has joined us in Melbourne. So welcome to the new team as we go in to celebrate our 25th year of helping families and not-for-profits in regards to their corpus on behalf of their beneficiaries. We have instigated an employee share scheme right across the business to ensure a stable team on your behalf. We are continuing to look at technology and how artificial intelligence may assist in our service and customisation for all of our clients. And I'm delighted to say the Providence Philanthropic Foundation year to date has made over $800,000 worth of donations to worthy causes. Well, once again, thanks for joining us and look forward to catching up in the next quarter.